Hello everyone, welcome back to the channel. Today, we are talking about something more and more people in the UK are quietly considering: moving to Hong Kong. You may have seen headlines about Ronnie O'Sullivan, the snooker world champion, who chose to relocate there. He said he wanted a fresh start and a new base for his career. But there's another reason behind the move. It's the tax system. For British citizens, the difference compared with the UK is striking. The core distinction is simple. Hong Kong operates a territorial tax system. You are taxed only on income that arises in or is sourced from Hong Kong. If your job, your business, or your investments generate money abroad, it is ignored for tax purposes. The UK takes the opposite approach. It uses residence-based taxation. If you live in Britain and are a tax resident, your worldwide income is pooled into the system, no matter where you earn it. A British citizen with investments overseas will still pay UK tax. The same person in Hong Kong will not. That single difference explains why so many professionals and entrepreneurs find Hong Kong attractive. The tax rates make the contrast sharper. In the UK, the top rate of income tax is 45%, and that is before national insurance. In Hong Kong, salaries tax is progressive and tops out at 17%. There is also a standard rate calculation, capped at 15% on the first £500,000 of net total income and 16% above that. So, no matter how much you earn, the government can never take more than that. Add to this the fact that Hong Kong has no value-added tax at all, and the gap grows wider. VAT deserves a closer look. In the UK, it is 20%, and it affects nearly every purchase. It also creates distortions. Eat in at a cafe, and you pay more than if you take food away. A gingerbread man is zero rated if he has 2 dogs of chocolate for eyes, but taxable if you give him more decoration. Jaffa cakes had to go to court to prove they are cakes. Small businesses even hold back growth when turnover approaches the £90,000 threshold, just to avoid being forced into registration. In Hong Kong, VAT does not exist. Consumers don't see prices inflated, and small firms don't have to fear a cliff edge that punishes them for success. National insurance is another area where the two systems diverge. In Britain, you pay national insurance alongside income tax, but it doesn't build a personal fund. The money is spent immediately to pay pensions and benefits, which means the system depends on younger workers paying in. In Hong Kong, there is no national insurance. Instead, there is the Mandatory Provident Fund. Employers and employees both contribute 5% of income, capped at £150 a month. The amount belongs to you. At 65, you can withdraw 100% of your savings and investment gains. Even though Hong Kong's fertility rate is one of the lowest in the world, just 0.7 compared with 1.4 in the UK, the system is not at risk. It is fully funded and not reliant on the next generation. Capital gains tax is another area where the difference is decisive. In Hong Kong, individuals pay no capital gains tax. If you sell shares, trade crypto, or profits from overseas property, the gains are yours. In Britain, capital gains are taxed at 18% for basic rate taxpayers and 24% for higher rate taxpayers. Dividends are also treated very differently. In Hong Kong, they are tax-free, with no withholding tax at all. In Britain, dividend tax rates run from 8.75% to 39.35%, and the allowance has been cut to just £500. Even modest portfolios are affected. Inheritance follows the same pattern. Hong Kong abolished estate duty in 2006. Britain still applies inheritance tax at 40% above the frozen threshold. For businesses, the comparison is equally clear. Hong Kong has a two-tier corporate profits tax. The first £200,000 of profit is taxed at 8.25%, and anything above that at 16.5%. In the UK, corporation tax is now a sliding scale, ranging from 19% on profits up to £50,000, tapering upwards and reaching 25% on profits above £250,000. That means many British companies face significantly higher effective rates than a similar business in Hong Kong. The difference in retained profit can be huge, and it explains why so many international firms still base themselves in Hong Kong. Healthcare shows both advantages and trade-offs. Hong Kong has a dual system. Public hospitals are available to everyone and charge a small fee. Accident and emergency cost about £18. Specialist outpatient visits cost around £13 for a first appointment and £8 for follow-ups. But waiting times can be long. If you want faster treatment and more comfortable care, private hospitals offer excellent service and much higher cost. Britain's NHS has no direct fees but struggles with capacity too. Each system has strengths and weaknesses. Your experience depends on income and expectations. Living standards for lower income people in Hong Kong can be difficult. The statutory minimum wage is about £4 an hour. In Britain, the national living wage is £12.21 an hour. Comparing directly is misleading without considering cost, but the gap is clear. Hong Kong's safety net is far less comprehensive. Public housing is available to locals, but conditions are basic. Private flats are extremely expensive, often tiny, several times more costly per square foot than in the UK. On top of that, owners often have to pay condominium management fees, which can be high and largely outside their control. These burdens make daily life tough for many residents. For British citizens, however, the calculation looks different. You can move to Hong Kong, enjoy low and simple taxes, build wealth faster, and then return to the UK later to benefit from the NHS and the state pension. Political conditions may not matter much if a plan is financial and time limited. This is why the city remains attractive despite its challenges. But the big question is sustainability. Hong Kong's government has long relied on land sales for revenue. With property prices down about 30% from their peak, that stream has weakened. The tax base is narrow. Proposals for a sales tax or even border crossing charges have surfaced, but none have become law. Whether Hong Kong can maintain its low tax regime in the long term is uncertain. Finally, there is politics. Since the national security law came into force, opposition parties have been sidelined and several independent media outlets have closed. Elections are tightly managed. Freedom of speech is more restricted than in the UK. For some, this is a deal breaker. For others, it is a secondary concern compared with the financial benefits. Still, the contrast remains powerful. In Britain, you can face 45% income tax, national insurance, 24% on capital gains, high dividend tax, inheritance tax, and 20% VAT on your spending. In Hong Kong, your local income is capped at 17%. There is no VAT, no dividend tax, no capital gains tax, and no estate duty. Public hospital fees are pocket change compared with private health insurance. MPF contributions are capped at £150 per month and belong entirely to you. The savings can be tens of thousands or even hundreds of thousands of pounds a year. That is why people like Ronnie O'Sullivan have made the move, and that is why British professionals and families are still considering Hong Kong. It is not perfect, but it is a global financial hub with one of the lowest and simplest tax systems in the world. So, here is the question. Would you stay in the UK, paying some of the highest taxes in Europe, or move to Hong Kong, adapt to its lifestyle and politics, and keep far more of what you earn? Let me know what you think in the comments. If you find this video useful, don't forget to hit like and subscribe. Thanks for watching. I will see you next time.